Hello and welcome back to What Changes. I am your host, May. Today, we are discussing a development that fundamentally alters the landscape of the global economy and specifically the precious metals market. We are talking about a shift that could mark the definitive end of the era of cheap silver. For years, investors and analysts have watched the markets for signs of a structural change, waiting for the moment when physical reality would overtake paper trading. According to the data we have before us today, that moment may finally be arriving. We are looking at a major policy development coming directly from the United States government. This is not a rumor. This is not speculation from an anonymous source. This is a confirmed policy shift involving the Vice President of the United States and a meeting of more than 50 nations. But this story is about more than just a government announcement. It is about a massive disconnect in the market. We are seeing a pattern where silver prices are being aggressively sold down during American trading hours, while physical demand around the rest of the world remains relentless. We are seeing delivery notices at the Comex, the primary futures exchange, hitting historic levels in a month that is usually quiet, and we are seeing market imbalances that are now larger than what we saw during the 2008 financial crisis. What happens when the United States government decides that the price of a critical mineral cannot be allowed to fall below a certain level? What happens when they establish a system to create price floors? That is the question we are answering today. If you have been wondering why silver struggles to break through the $90 level despite overwhelming demand, or if you are curious about why the United States is suddenly treating silver as a strategic asset comparable to oil, you need to hear this breakdown. Let's dive into the details. Let us begin with the headline news, which is the catalyst for this entire discussion. Major policy developments have just broken regarding critical minerals in the United States. United States Vice President J.D. Vance recently addressed a meeting of more than 50 countries. The goal of this meeting was specifically aimed at boosting access to critical minerals. During this address, the Vice President announced that the United States will establish a system creating price floors for these commodities. This has been confirmed by Reuters. The United States is officially moving to establish a price floor system for critical minerals. This is big news. In the global scramble for resources, nations are realizing that securing supply chains is a matter of national security. And here is the key detail for our audience. Silver is included in this system as a classified critical mineral. Now, we need to understand what this actually means. What is a price floor, and why does it change the game? Fundamentally, a price floor is not about the paper markets. It is not about day trading or speculation. Price floors are designed to ensure that domestic production remains viable. If the market price, the paper price, drops too low, it becomes impossible for miners to extract the metal at a profit. If they cannot make a profit, they shut down. If they shut down, the United States loses access to a strategic asset. To prevent this, the government sets a minimum price. They are essentially saying that you will not be able to sell or buy silver below a certain price. Think about the implications of this. We are used to a market where the price is discovered by traders buying and selling futures contracts. But a price floor mechanism introduces a new player, the government. If the market price falls below the floor set by the government becomes the buyer of last resort at that floor price. This is unprecedented in modern precious metals markets. We have seen similar mechanisms before, such as the Strategic Petroleum Reserve for oil, which allows the government to manage energy security. Now, critical minerals, including silver, are getting the same treatment. This leads us to a critical question that very few people are asking right now. What if the silver price floor is set above the current paper price? As we look at the data, we know that the paper price is currently trading around $86, but price floors are designed to keep production alive. If the government determines that the floor needs to be set at $90 or even $100 to ensure viability, what happens to the paper market? The paper market would be forced to adjust. If the floor is higher than the spot price must rise to meet the floor. This would not be a standard market rally. This would be a repricing event. You must know the difference. A rally is market sentiment. A repricing event is a structural adjustment forced by reality. The government is choosing strategic minerals over speculative assets. It is interesting to note that while the crypto industry asked for a strategic Bitcoin reserve, the government instead created a critical mineral reserve, which includes silver. This tells us exactly what they view as actually critical. They chose physical commodities essential to defense, technology, and energy infrastructure. While the government is preparing this long-term structural support, the current market action is telling a very specific and somewhat suspicious story. There is a clear pattern developing in the silver market today. We need to look at the price action around the $90 zone. Repeatedly, we have seen silver prices attempt to break through $90, and repeatedly, we have seen them get rejected. Recently, we saw a rejection from the $90 zone where the price fell back to $83. That represents a drop of 8 to 9% from the highs. But it is not just the drop that matters, it is when the drop happens. This event occurred during the New York trading session. This was the same pattern as the day before. Silver prices posted a massive reversal, falling nearly $9 per ounce in under 3 hours. At the same time, gold prices also fell $220 per ounce in under 3 hours. What pattern do you see here? Let's look at the timeline. During Asian and European trading hours, silver rallies. Investors in these regions are buying. The price goes up. Then, as soon as the New York session opens, massive selling hits the market and the price reverses. It happened yesterday, up to 90, then back down. It happened today, up to 90, then back to 83. The $90 zone is acting as strong resistance, and the New York session is consistently where the selling pressure appears. This suggests a bifurcation in the market. We are up all night on global physical demand, and we are down all day via derivative selling in New York. That is the pattern. Physical buyers are accumulating overnight. Paper sellers are dumping during United States trading hours. This raises a massive question about market integrity and true value. If the rest of the world is buying, and the price is only collapsing during a specific window in the US futures market, are we looking at true price discovery? Currently, as we analyze this script, Western spot silver is at $86. Western futures are at $86. But look at Shanghai. Shanghai spot silver is at $102. Shanghai futures are at $101. That is a massive discrepancy. The Shanghai premium is $16, or roughly a 19% premium over the Western price. This confirms the pattern. The physical market in Asia is valuing silver significantly higher than the paper market in New York. While New York traders are selling paper contracts and driving the price down to $83 or $86, buyers in Shanghai are paying over $100. So, we have a tug of war. On one side, we have the New York paper market rejecting price at $90. On the other side, we have the Shanghai physical market paying a 19% premium. And looming over all of this is the new US policy of a price floor, which suggests the government knows the price needs to be supported. Now, let's move from price action to the physical delivery data. This is where the story gets even more compelling. We are seeing numbers coming out of the Comex that are simply not normal. Let's talk about February. In the commodities market, February is typically considered a non-primary delivery month. Usually, primary delivery months like March, May, and July see high activity, while months like February see minimal deliveries. But that is not what is happening this February. In the first 4 days of February alone, 14.8 million ounces of silver delivery notices hit the Comex vaults. Let me repeat that number so it sinks in. 14.8 million ounces. To put this in perspective, let's look at the open interest. Open interest refers to the number of active contracts held by traders. At the close of business on January 30th, the open interest in the February silver contract was just 1,231 contracts. However, by the following Tuesday, only 2 days later, 2,955 delivery notices had been issued for the February contract. This means that nearly 3 times the entire open interest in the February contract at the end of January has issued delivery notices within the first 2 trading days of February. How is this possible? It means that new longs, new buyers, are entering the market and standing for immediate delivery of physical silver. They are not buying futures to trade the price. They are buying futures to take the metal. Open interest remains low because these buyers are taking the metal and leaving. This is a classic stand for delivery scenario. We are seeing delivery notices of 2,955 contracts against an open interest that was much lower. That is 2.4 times the open interest demanding physical delivery. This confirms that physical demand is relentless despite the volatility we are seeing in the paper price. While the New York trading session is dumping paper contracts to drive the price down to $83, someone else is stepping in and taking 14 million ounces of physical silver out of the market. This is the second month in a row that a non-primary delivery month has seen historically massive silver delivery notices. Why would buyers demand immediate delivery in a non-primary month? Because they want the metal now. They are not willing to wait for the standard delivery cycle. They are seeing the same risks we are discussing, and they are securing physical assets immediately. We have discussed the government policy. We have discussed the price manipulation pattern. We have discussed the massive physical deliveries. Now we must look at the structural health of the market itself. There is a metric that experts use to gauge the stress in the silver market, the one-year silver swap minus US interest rates. Right now, this metric is showing silver market imbalances that are larger than during the 2008 financial crisis. They are also larger than during the 2011 silver mania. This is a critical piece of data. A sell-off driven by over-leveraged paper positions is not the same as real oversupply. The price drop we see on the charts might look like weakness, but the structural imbalance tells us that the market is at historic extremes. When the structural imbalance is this high, larger than 2008, larger than 2011, it implies that the rubber band is stretched to its breaking point. The tension is building, and now, into this high-tension environment, the US government is stepping in with a price floor system. You have to ask yourself, does the government know something the average trader does not? Why implement a price floor system now? Perhaps because they see these imbalances. They know that domestic production must be protected because the market is becoming unstable. We also have to look at the other whales in the market, central banks. Central banks are the quiet, underappreciated, and unseen whales in this market. For the past several years, central banks led by China, Russia, India, and Turkey have been buying gold at a historic pace. They just topped 5,000 tons for the first time in history. This relentless central bank buying acts as a massive, price-insensitive bid in the market. They are not trying to scalp a few points like a day trader. They are accumulating strategic reserves for the long term, and they are doing so in ever larger numbers. Americans, for the most part, seem to be totally unaware of this intense gold and silver buying that is happening around the rest of the world. There is a misconception that because Americans are not buying, the rest of the world is not buying. The source explicitly warns that Americans will pay dearly for that ignorance. China's demand for gold and silver is stable. Physical demand globally is not collapsing. It is only the paper price in New York that suggests weakness. We cannot view silver in a vacuum. We must understand the broader economic context that is driving these moves. Today, we are seeing significant risk-off sentiment spreading across all asset classes. US stocks are dumping. The S&P 500 is down significantly, erasing about $580 billion in market value in a single day. The Nasdaq is down, wiping out roughly $1 trillion in value. The Russell 2000 is down. Risk is being sold across the entire US market. At the same time, geopolitical tensions are escalating. Nuclear talks between the US and Iran, which were scheduled for Friday, have reportedly been cancelled. On this news, oil prices are surging to $65 per barrel. We are also seeing massive swings in sentiment in Chinese markets. China's four largest gold-backed ETFs posted negative outflows of $980 million on Tuesday. This was the biggest daily withdrawal on record. This follows negative outflows on Monday as well. This volatility is shaking out weak hands. It creates an environment of fear. In such an environment, paper assets are sold, Bitcoin positions are down, Ethereum is falling. But this is where the opportunity lies for those who understand the structural difference between paper and metal. The pattern we identified, rejected at $90, risk-off sentiment spreading, geopolitical tension, suggests that we could test lower levels again before finally breaking through. However, the bearish case is overwhelmed by structural developments. Why? Because of everything we have just discussed. The US is establishing a price floor system for critical minerals. 14.8 million ounces of silver were delivered in 4 days. Silver market imbalances are larger than in 2008 and 2011. Central banks are accumulating at a record pace. The $90 rejection pattern during New York sessions appears to be paper manipulation, while the price floor system announcement is government policy responding to strategic necessity. Ray Dalio has called for gold to be the world's new currency to replace the fiat system. It is the beginning of the end of the monetary system as we know it. For this to happen, gold, and by extension silver, would need to trade significantly higher than current levels. The entire system is being repriced. Nothing looks organic anymore. Every asset class shows signs of manipulation. The goal isn't to fix the system anymore. It is to extract value before restructuring. So, where does this leave us? We have covered a vast amount of information, so let's cut to the chase and synthesize the 3 must-know takeaways from this analysis. Takeaway number 1. The United States government has changed the game. Vice President Vance's announcement of a price floor system for critical minerals, including silver, fundamentally changes the market structure. This is not market speculation. This is government policy. Price floors are designed to keep domestic production viable. If the floor is set at or above current paper prices, the paper price will be forced to adjust upward. The Strategic Petroleum Reserve model is now being applied to critical minerals. The implications for silver are enormous. Takeaway number 2. The physical market is screaming shortage. We have seen 14.8 million ounces of silver delivery notices in the first 4 days of February. We have seen 2,955 contracts issued for delivery against an open interest of only 1,131. This is happening in a non-primary month. New longs are entering and taking metal immediately. This is the second consecutive month of historically massive deliveries in non-primary months. Physical demand is relentless, regardless of what the paper price says. Takeaway number 3, the battle at $90. We have a clear pattern. Silver is rejected at $90 during the New York session, dropping 8 to 9%. We are up all night on global physical demand and down all day via derivative selling in New York. We have resistance at the 150-hour EMA, but here is the unresolved tension that you must watch. On one hand, we have the price floor system being established by the US government. We have historic physical deliveries. We have market imbalances at record extremes. On the other hand, we have the consistent New York selling pattern that refuses to let the price break $90. Does the $90 rejection pattern continue until the price floor mechanism is actually implemented? Or do we break through sooner, based on physical demand, finally overwhelming paper supply? The government is responding to strategic reality. The paper market is responding to leverage and positioning. Which force wins? The short term will determine if we test lower prices or finally break 90 and head toward the resistance at $96 or $97. You must do your own due diligence. You must understand the risks. The $90 rejection pattern is real. The risk-off sentiment is spreading, but the US government is establishing a floor. The paper pattern and the structural policy developments are currently moving in opposite directions. You need to know which time frame you are trading. Are you trading the daily fluctuation of the paper market? Or are you investing based on the structural reality of government policy and physical scarcity? Invest with logic, not hype. Use your own brain. Do not follow anyone blindly. The era of cheap silver may be over, not because of a hype cycle, but because the United States government has decided it can no longer afford to let the price collapse. This has been May with What Changes. Thank you for listening.